Hello, everybody. John King with Summit Funding. Thank you for joining me for my Financial Fridays, where I come to you every single Friday, giving you important information to help current or future homeowners in being able to build wealth through real estate and really just managing your overall wealth and helping you to make the right decision based upon a lot of crazy information that's out there. And I want to do my best to keep you updated and keep you informed. So appreciate you joining me every single Friday at 12 noon. We will be broadcasting this live except today and next Friday. So I am now in Hawaii. I'm not now in Hawaii. Doesn't look like Hawaii behind me either, but I am in Hawaii with my family. So I recorded this before I left on vacation. And so this will be played because I promised that every single Friday I would be broadcasting a 12 noon broadcast, and I'm going to meet and make and keep that promise. But I have to pre record this broadcast in order to make sure that I am delivering the 12 noon that I promised. So let's go ahead and get started with today's broadcast. We're going to be talking about credits. We're going to talk about credit and how it works, how to maximize it, but also how to build it and how to repair it. Credit is probably the single biggest source of misinformation that exists in anything that I talk to people about. Um, I think of credit kind of like I think about advice you get from a doctor. And when you go to visit a doctor, the doctor will say, "Hey, I think you should take this particular pill to deal with your high blood pressure." And so you go home and it works and everything is great. And then your spouse finds out a year later they have high blood pressure, and you say, "Hey, I got some pills left over. Here's my pills. Why don't you go ahead and take my pills because they work beautifully for me?" And it could cause major problems, even death, for somebody else because their body has a different set of issues that pill might have caused a reaction. The same holds true for credits. Somebody said, "Hey, I fixed my credit by paying off all my credit cards." But depending upon your credit history, the diagnosis of what is caused you to have the credit challenges and what the ailment you're trying to fix will determine what is the steps that we should appropriately take. And sometimes something that helped somebody significantly with a similar set of circumstances would harm you significantly. And that's really a super, super important key that I want to drive home today. So we're going to be spending the next hour together, a lot of in-depth information that I'm going to cover with you during that hour. So sit back. Because it's not live, I won't be able to respond to questions immediately, but I will be watching this replay afterwards and commenting back. So if you have a comment, do me a favor, just give me a shout out and say hi right now so I know that everybody's watching. If you don't already subscribe to my YouTube channel, please go to youtube.com/John Lone King. And subscribe to my YouTube channel, hit subscribe, and then click the little bell for notifications. You'll get notified every time that I post a new video or that I go live. And I'll be doing this every single Friday at 12 noon. So let's go ahead and get started with today. And the topic again is how to understand and manage your credit profile. So I'm going to dive in. The first thing I want to give you is an overview of the credit system. So everybody says FICO this, FICO that. FICO is the company that created the most prominently used credit scoring model, but there's actually three different models. They've got the FICO score, you've got the plus score, and you've got the Vantage score. I am not going to spend a lot of time going into each one of these three models. What I want to explain is that they each use the same data. So you say, "John, you talked about FICO and Plus and Vantage, but I heard about it in the past. I thought it was Experian and TransUnion and Equifax. So why are you saying these three names and you're not saying Experian, TransUnion, and Equifax?" Well, Experian, TransUnion, and Equifax are the companies that house the data. They house the information about who do you owe money to, how much do you owe them, when is the last time that you paid them, did you pay them on time? So it houses the data. The scoring model interprets the data. That's super important to understand is that you can have an Experian report using a FICO score, and it gets a little more confusing because there's multiple levels of FICO scores, and I'll talk about those in a couple minutes. There's multiple versions of FICO scores. But you can have an Experian report showing you a FICO score or a plus score or a Vantage score, and you're going to get different answers, not only because the formula from FICO Plus and Vantage are different, but the data that is received from each of the three credit repositories. The credit repositories, Experian, TransUnion, and Equifax. Those three credit repositories don't always have all the same information. They don't have the same um, knowledge of who you owe and what you owe to each person. And so it's really important to understand that there is significant differences between these three models. And be careful, by the way, when you see the word free, like on the plus score, it says, freecreditscore.com. Rarely is anything free. I'll tell you a little bit later how you can truly get a free copy of your credit report. And it is important for you to do that periodically, but most of the time you cannot actually get a free credit score. Okay, so that having been said, let's go ahead and move on to what is the FICO score and who determines it. So first of all, as I talked about already, it's a model that is based on historical data. It's based on how well has somebody paid their bills in the past and what was their statistics. So, for example, the FICO system might look at it and say, hey, for somebody who's buying a car and has paid well on their car, they typically had this many credit cards with this much imbalances on those credit cards and this many mortgage loans with this history on their mortgage loans versus somebody who paid bad on their car had this many credit cards with this kind of a balance compared to their credit limit. That's called utilization. And I'll talk more about that in a few minutes. But they're continuing to refine the model and they're trying to figure out what your risk level is. They're trying to predict the future and saying, are you going to pay me back on time based upon how similar your profile is to people that paid me well and how similar your profile is to people who didn't pay me well. And so it is super important to understand that the model is always evolving and they're always changing what goes into a credit score. And it's different based upon what company is reporting it, whether it's coming from Equifax, Experian, or TransUnion, and whether it's coming from the FICO score or the Vantage score or the Plus score. Now, I'm going to talk mostly about FICO. And what I'll tell you is the average FICO score, the average score is 695. The median is 704. Median says half the people are above and half the people are below. Average is a weighted average. And so the bottom line is if you're 690s to 710s, you are typical. If you're above that, great job. If you're below that, you still have options, but you got a little bit of catching up to do, and that there's something about your credit history that is dragging you down. So we also want to kind of compare by age. Let me make this one a little bit bigger. Um, 18 to 24-year-olds, they're just starting out with their credit. And I'll give you some examples of things we can do to build up credit for younger children. But the key is at 18 to 24 years old, the average credit score is closer to 635 to 640. Once you hit your 25 to 34-year-old range, the average score is about 650. We get to about 660. It's not until closer to 45 to 54 years old before you start pushing a 690 credit score on average. So understand that demographics plays into this a little bit, but from a lending perspective, we're basing it simply on what your credit score is. We're not going to say, man, you're a 25-year-old and you have a 690 credit score. That makes you perfect. No, because we're still looking at the overall credit profile and saying, hey, this is the ideal credit. And we'll talk about how ideal credit plays in here in a few minutes. Here's the deal. This is the number one thing people ask me all the time. John, what is the formula for good credit? The answer is there isn't an exact formula. It's a secret. They don't tell us. And here's why. Because they don't want you or me modifying, manipulating your circumstances to make your credit score look better. They're basing the credit decision. A bank is basing their decision saying, do I want to loan you money? And they're basing that decision on how well you've paid other people in the past and what your profile says you'll do in paying people in the future. They do not want that manipulated. Okay. We pay attention. I've been doing this for 22 years and I pay a lot of attention to this kind of stuff. I'm a student of my industry, and you'll get that understanding as we talk about credit over the next 50 minutes. By the way, if you have questions about anything, please post them into comments. As I mentioned, I'm pre-recording this, so I won't be live answering them, but I will answer them after the fact. Make sure you like and share this as well. I would really, really appreciate that. So here's the thing. the credit scoring formula evolves over time. As an example, here we are in 2022, and we had a significant issue with COVID 2 years ago that shut down the economy. Now we're dealing with a whole different set of circumstances where we're dealing with an oil crisis, we're dealing with an inflation crisis, we're dealing with a potential stock market correction. We've got a lot of things that are going on right now. We've got student loans that people haven't made payments on student loans for over 2 years because student loans went into forbearance because of COVID. I'm broadcasting this on April 15th. By the way, tax day. If you haven't done your taxes, make sure they're done today. Um, and the student loan forbearance was supposed to end May 1st. I just saw something recently that said they extended that, and I think they're pushing it out to September or October. So how do we calculate somebody's risk profile when nobody's had to make a payment on student loans in 2 years? Whether you were able to make them or not, you didn't have to, and most people don't. So that risk criteria will change regularly, and that's where this evolves. You also have different filters per industry. Now, this is not John King's filter. This isn't Summit Funding's filter. It's the filter for the mortgage industry. And it says, hey, mortgage companies care about certain things. They're using this version of the FICO scoring system. You often will hear, if you pay attention on radio ads from car dealers, they're going to say, hey, you can get the new Lexus for $999 a month, 780 auto FICO score required. They're going to throw out the word auto FICO score required. The reason why they say auto FICO score is because that's the automotive filter, the automotive industry's version of the credit score. Now sit down for this. This is super crazy, but I want you to understand it. Your score will be different with different industries on the exact same day, and it will be different for the classic or unfiltered score. So you can go on to um, myfico.com. It is the only place I know of that does this. If you subscribe to myfico.com, you can actually pick which filter you want, and you can see your mortgage score today. But if you go onto your credit card or your banking website, you're going to get a different score. A Credit Karma is a totally different score. I'll talk about that in a few minutes. And how do we know what helps? That's really important. It's experience and anecdotal evidence. I have tools such as a credit simulator. Once I run your credit, I can now run simulations and say, what if I pay this off? What if you open up a new credit card? What if we wait 6 months and pay down your balances over that time frame? And it will predict what your credit score is based upon those simulations. I use that information to give feedback. It's what I built this presentation on, is a lot of the information that I've learned. But I'll tell you, as good as I am, probably 20% of the time when I plug into the what if saying, okay, I think if we take this step, and this step, it's going to get the credit score where we need it to be. And about 20% of the time, it doesn't work. Now, two reasons for that. First of all, is it has to do with the history of that particular person, and that the steps I think are going to help, the model does not like, or the model has evolved. And what used to work doesn't work anymore. But I'm running those simulators multiple times a day. And so I'm staying on top of what really does work and what doesn't work to help you give great advice. So I want to take a few minutes and talk about what goes into a credit score. And this is really important when we think about these percentages of what goes into a credit score. And we're going to talk about payment history. Payment history is the biggest thing. It is the amount that you owe. Oops, sorry about that. Payment history is the amount that you've paid every single month. And let me rephrase that. I'm saying it wrong. It is the fact that you paid on time every month. It has nothing to do with the amount that you paid. So if you pay extra, as long as you paid on time, that's all that matters. If you pay the minimum, as long as you paid on time, that's all that matters. So payment history is 35%. It's greater than 1/3 of your credit history. Your credit score is based upon, did you pay all of your payments on time? The next biggest part is amount owed. Amount owed is super, super important. Now, what it didn't say is credit limit, but most people misunderstand that. And they think, oh my gosh, my score is going to drop because I've got a bunch of available credits. That is the opposite of the truth. Good credit comes from demonstrating self control. The fact that you have the ability to owe more money and you have the self control to not go charge it up is a great sign. If you close your credit cards, you end up in a position where you have no available credit. It looks like the only reason you don't owe more is because nobody will trust you with anything more. That is not a good position to be in. And I'll tell you, I'm getting concerned as we head further into 2022. We're dealing with some major economic challenges because interest rates are moving up significantly right now. The Federal Reserve has made it clear they're going to continue raising interest rates, especially on credit cards, car loans, things like that. The rates are going to go up pretty significantly. And what I'm starting to hear banks doing is banks are starting to trim your available credit. They're worried. They're worried that we're going to end up in a recession and that some people are going to lose their jobs. The truth is, I don't see how we avoid a recession. We're going to end up in a recession. Now, that doesn't mean that the world goes crazy and that everything is all kinds of bad. Recession simply means that the US economy is producing less goods and services than what it had been producing. So it is a slowdown. And when things slow down, some people lose their job. That is horrible. I don't want anybody to lose their job. It is unfortunately the truth. Some people are going to lose their job in a recession. But and that's what the banking industry is worried about. Is they're worried about some people when we end up in a recession will lose their job. The banking industry is also worried that as inflation goes up and it costs you more money to buy groceries and to buy gas and your interest rate goes up on your credit cards and your car loans, that they're worried you're not going to be able to afford to pay for your credit card and they don't want you to use your credit limit to rob Peter and pay Paul, to borrow money on your credit card and take cash advances in order to string along in tough times. So they're going to start reducing your available credits. If you have a $10,000 credit card and you owe $1,000 on it, your utilization, the percentage you owe of your credit limits is 10%. That's beautiful. Between 10 and 25% is perfect. So when we talk about amount owed, which is a little bit less than 1/3 of your credit score, we're talking really about utilization. How much do you owe compared to what you could owe? The smaller the number, the better. It says I have self-control and that I have the ability to borrow money, but I choose not to. If and when the banks start cutting back your credit limit and saying, hey, I know you had a $10,000 limit and you owe 1,000, but I just don't want to risk you charging up a whole bunch of money. So I'm going to lower your credit limit down to $1,000, which is matching what you owe right now. Now your utilization went from 10% to 100% utilization. That amount owed becomes a bigger problem and your credit score will drop. So it's something I'm concerned about. There's really nothing you can do to get ahead of this curve, but just be prepared. It is definitely going to get more expensive to borrow money. And as we get deeper into the challenges that we're facing, we're actually going to run into situations where it's more expensive to borrow money and your credit score may not be as good because of things outside of your control. All right, so payment history and amount owed is literally 65% of your credit score. So almost 2/3 of your credit score. The third thing is length of credit history. How long have you had credit? That's only 15% of your credit score, but length of credit history is about can you maintain a relationship with a bank? So here's my advice when you are starting out and building new credits, get a credit card as early as you possibly can, especially as you turn 18 and you get into college. They hand out credit cards like candy. And here's why. Because first of all, everybody's on a level playing field. Every 18-year-old is potentially going to be a great client of that bank and potentially going to be a default, potentially going to turn into bad debt for the bank. But the bank is willing to take that risk, especially because a lot of college students, when they get in financial trouble, turn to mom and dad to bail them out. So the bank doesn't have a huge risk here. They give you a $500 credit card or a $1,000 credit card. Statistically, let's say half the students are going to pay on time perfectly. Anybody can get a credit card when you're 18. The other half that don't pay on time, half of them, the parents are going to bail them out. So it's only really a quarter of the credit cards they issue that they have to write off as bad debt. That is a worthwhile investment in marketing to find new consumers, new clients for the bank. So you get that credit card at 18, it might be the most expensive interest rate you ever have. It might be the highest annual fee of any credit card you have, but never close it because they look at the average age of your credit cards. It's like being 40 years old and never have been on a date. And you go out on your first date, and the person you go out on a date with says, "Really? You've never been on a date?" In the back of their mind, they're like, "What's wrong with this person? Like, why, how are you 40 years old and never even been on a date? There's something wrong." And that's the same thing if you're 40 years old and your oldest credit card is 1 year old. Does that mean you had a bankruptcy 10 years ago that's now fallen off your credit report? Does that mean that you charge up credit cards and then you don't pay them and then you close them and then you've waited a while? Like there's a lot of concerns about why can't you maintain a relationship with a bank? And so length of credit history is super, super important. The next thing that's important is new credit. Now, this is the one that everybody freaks out about. Oh my God, I can't have my credit pulled because there's an inquiry. Oh my gosh, I can't open a new credit card. It's going to hurt my credit. It's only 10% of your credit score. Very, very little impact to your credit score. We'll talk more about inquiries later. The last component is types of credit used. Now, types of credit have to do with what type of institution did you borrow the money from? There are, for example, finance companies that are known for providing hard money loans. Let's say it's a car loan. If you've got a car loan from a major bank or a major credit union, that's normal. You got a car loan from a mom and pop shop, that's a concern because it says you probably weren't able to qualify with a major company. So there's something about your situation. There's also things like how you have credit cards versus student loans versus installment, like a consolidation loan. Comes into play. You want to have a healthy balance of different types of credit is best for your credit score. Let's talk about what does not go into credit score. I'm not going to read through all of this stuff. I'm just going to let you look at it really quick. So there's a lot of things. I'm going to point out a couple of them that are really misunderstood. Your interest rate on a credit card does not go into your credit score. Things other the certain types of inquiries. You can do a soft inquiry. We'll talk about those in a few minutes. Credit counseling and whether you've been in credit counseling doesn't go on into your FICO score. There's a lot of things that do not play into your FICO score that people think do. So let's talk about why scores are different. I already covered a little bit of this. There are 9 different platforms that FICO uses. So you've got, like I said, automotive, you've got the classic, you've got the mortgage, 9 different platforms that they use, department stores, etc. Each of them have different predictors that say, hey, somebody's going to be successful in paying for furniture because of these things that have happened in their past versus somebody's going to be more successful paying for a car or department store credit card based on other things that have happened in the past. So that is just a basic idea of what goes of the different platforms. So I talked about this a little bit earlier. I'm going to gloss over this really quick. We talked about payment history. Payment history is number of accounts that are past due. Here's the deal. The first time that you have a late payment makes a very big impact to your credit score, but it also is forgiven pretty quickly. So let me explain to you what I mean by that. If you've got perfect credit and you have one late payment, the moment that it's late, it's a really big deal. Your credit score is going to drop significantly. But as soon as it has been 3 or 4 months since it was late, and that was the only late you've ever had, your score will rebound most of the way back up because everybody's allowed a mulligan. Everybody has one thing that went wrong. Hey, it wasn't your fault. And it was proven that the late payment was an anomaly. The opposite holds true, though. If you have a pattern of late payments in the past and you finally have gotten everything together and you've had 6 months to a year of no late payments, so your credit score was in the 500s and you had horrible payment history and you finally got everything up, you paid it on time for the last 6 to 12 months, now your credit score's made it up to 640. You have one new late payment. Your score drops back down to the 550s and it could take another year of on-time payments to bring it back up. And the reason why is because of the pattern and the fact that you had a pattern of paying late for such a long period of time. You had a short window where you were good, and now you're late again. The pattern was never broken. Versus if your pattern's being really good and you've always paid on time and you have one late and now you get back to paying on time, your pattern is that you're a good credit risk and that late payment was the anomaly. Let's talk about a couple of things that more about credit history. So the payment history has to do also with length of time since a delinquency was reported. So if something was delinquent over 2 years ago, it will have less of an impact on your credit score. But delinquencies in the last 2 years are a very, very big deal. Public record items. So here's where it gets interesting. Things like a bankruptcy filing will show up on your credit report and it will impact your credit score. But liens, civil judgments and liens no longer show up on your credit reports. We pull a different report called a liens and judgment report because we've got to make sure that no liens exist. The problem is that a lien does not necessarily mean it was yours. It might have your name, it might have a similar city that you lived in. And so the credit system uses enough matching criteria and says, yeah, that's probably you, but it doesn't have an exact match. Liens very rarely have your social security number, which is the identifier that we use. And the law says a credit score cannot be negatively impacted by things you cannot be 100% sure belong to the consumer. And so your liens, your civil judgments, your federal tax liens, your state tax liens will no longer, for a couple of years now, will no longer impact your credit score. It still matters to getting a mortgage, but it no longer impacts your credit score. This we talked about already a little bit. Amounts owed on revolving credit cards. 30% of your FICO score is based on that. The key is to keep the balance ideally below 30 to 25% compared to the credit limit. And one really big thing that's going on right now, mortgage rates have gone up a lot. A lot of people are talking about refinancing and saying, hey, it's not worth it to pull cash out because I've got a 2.5% mortgage rate and I don't want to refinance to 5. So I'm going to take a home equity line of credit. A home equity line of credit can hurt your credit score. The reason it hurts your credit score is because you borrowed $50,000 as your line of credit and you pulled the entire $50,000 out. That impacts your utilization and it says you're using 100% utilization. Let me give this to you guys in a different way of thinking. So I've got an anecdote that I talk about a lot when it comes to credit history, building and repairing credit history, specifically around credit cards and utilization. So we're going to think about a 5-year-old. Okay. So if you had a 5-year-old and you took a 5-year-old to the dollar store with $5 in their hand, the 5-year-old has no impulse control. They're going to find 5 things that they want to buy, and they're going to have all 5 of those things because they have zero self control. And that is very, as a matter of fact, the 5-year-old's not going to understand what tax is and why I can't get 5 things at the dollar store for $5. And actually, we all found out now the dollar store isn't even a dollar store anymore. It's $1.25. But go with me and assume it's $1 an item. So the 5-year-old has no self-control. And that is just like you having a credit card for $1,000 and you owe $1,000. You're telling the credit system, I have no self-control. Up my credit limit by $500 and I'll find a way to spend the $500. And that now can be fixed by saying, okay, fine. I'm going to take my 5-year-old to the store, but I'm only going to let him bring $1. Then he's only going to be able to buy one thing. That's kind of like you saying, hey, I'm going to lower my credit limits. And I'm going to keep them really low because, hey, if I have $1,000 to spend, I'm going to spend 1,000. So I'm going to lower my credit limit to $100. And that way I'll only spend the $100. But that didn't prove self-control. All it proved is that you can obviously not spend money you don't have unless you're the federal government, which finds a way to spend lots of money they don't have. But going to the dollar store with less money in your pocket doesn't prove self-control. So the next thing you say is, fine, I'm no longer going to take my 5-year-old to the dollar store because they can't prove self-control and I'm just not going to take them. That's like not using your credit cards. Does that prove self-control? It does not. It proves avoidance. So if you cut up your credit cards and you pay them off and you never, ever, ever use them, the credit system understands that because they don't see activity, they don't see balances, and they think, well, this doesn't prove this person's able to manage their credit. It doesn't prove they are responsible or have self-control. It proves that they can avoid using credit, and that doesn't make me feel better because they want me to loan them money Can I trust them when they're avoiding using credit? So how does a 5-year-old prove they have self-control going to the dollar store? They go to the dollar store with $5 in their pocket and they leave only buying one thing. That proves I can spend the money, but I don't want to. And your self-control is demonstrated, and that proves your credit worthiness. So if you're trying to rebuild or build credit, the number one thing I will tell you is open up a credit card, never pay it off, never let the balance get above 30% of the credit limit, never let the balance go below 10% of your credit limit, and only make the minimum payment. So you're just paying a little bit at a time. But you have to remember your credit score is a snapshot of one moment in time. And if you charge up your balances and then pay them off every month and charge them up and pay it off, that one moment in time might be the moment that it was completely charged up. So if you have great credit, who cares? Because great credit is elastic, it'll breathe. I'll talk about that in a few minutes. But if you're rebuilding credit, you cannot afford for your credit score to breathe like that. You cannot afford for your balances to go up and down that significantly. So just be aware that you need to keep using credit without allowing it to go too high compared to the credit limit. So let's talk about amount owed on installment loans. I talked about this a little bit, but here's a good example of amount owed on installment loans. If you owe more than your credit limit, and maybe that's on a credit card, maybe it's on a student loan, as I'm talking about here, then you're basically saying, hey, somebody trusted me with $1,000 and I couldn't even control myself and I owe 1,100. I owe more than they trusted me with. This can show that you are overextended. It may not be true, but it can show that you're overextended. And here's a real life scenario where that can happen. If you co-sign for a child on a student loan, they might not have to make any payments on that student loan, but interest accrues. So the student loan started out at $10,000, but because interest is being added, the balance now might be $10,500. It looks like you are overextending, that you're actually owing more than you were originally loaned, and that will hurt your credit score. Again, life is not meant to be lived to maximize your credit score, but don't be confused in thinking that these things aren't impacting your credit. It all comes into play. Length of credit history. I talked about this a little bit more. One of the things that I'll tell you is two things. First of all, you have to have credit history, active recent credit history, in order to get a credit score. So you won't get a credit score if you have not had an active account in the last 6 months. That means that if you lived off the grid, you pay cash for everything because cash is king. First of all, I am king. Cash is not king. But you say cash is king, and therefore I'm going to pay cash for everything. I don't need to have credit cards. I don't need a car loan. I don't need a house loan. You're off the grid. If you haven't had any active accounts, even if your credit was stellar, we don't know if that's really who you are anymore. So we can't give you a credit score, not we, the credit system doesn't give you a credit score. Okay. Now that also works in the opposite. You can inherit somebody else's credit history. This is a bit of a loophole right now. The credit systems are trying to close this loophole, but right now it hasn't been closed. You can inherit somebody's credit history that says, hey, um, I'm going to add somebody as an authorized user on my credit card. When I add somebody as an authorized user on my credit card, it doesn't start over as a new account. They their credit history gets my credit card's data added to their credit history from the date I opened the credit card instead of the date they were added. So they're inheriting my credit history, good or bad. So this can be a very bad thing if the person that you're an authorized user for has high credit utilization or has had bad payment history. But if you've got a spouse, a child, somebody that you're trying to help improve their credit score, one of the great ways to do it is to add them as an authorized user to your account. They inherit your credit history, and that can give you a boost to your credit history immediately. All right, new amounts. So we talked about it's a small amount on the new credit score, so it doesn't make a huge difference. And it really is looking over the last 2 years of how many of your accounts in the last 2 years are new compared with the total number of accounts that have been added. Type of credit, I talked about this a little bit already, so don't need to go that far into depth, but we are talking about Is it how many revolving accounts do you have versus how many installment accounts do you have? There's lots of pieces that come into this, but it's such a small part that I wouldn't worry about it too much. So let's talk about inquiries. Inquiries is a really big deal that I get a lot of people misunderstanding. They think, John, I know you want to pull my credit because I'm trying to buy a house, but I don't want to ruin my credit by having you pull a hard inquiry. Here's what I'll tell you. First of all, it's a necessary step. Think about going to your doctor right now and saying, Doc, I fell down yesterday and I think my arm is broken. I'm not really sure, but it feels like it's broken and it felt the same way as it felt a year ago. Can you fix my broken arm? Well, yeah, let's just do an x-ray and let's see for sure where the break is and how bad it is and how we should address it. Nope, 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 doc. I'm not willing to do that. You see, I read this article that says that radiation's bad. And I don't want to have any of that radiation stuff. So can you just fix it and tell me at least if I'm going to be okay without doing the x-ray? It's impossible for a doctor to do that. It's impossible for me to diagnose you without having the proper testing done. And it doesn't help that you have a copy of your credit score from somewhere else or a copy of your credit report from somewhere else, because we run the credit electronically through our system. We need to have the electronic version, not a paper version sent over. So it's really, really important that we pull your credit, but it's such a small impact to your credit score. We only look back 4 months on your credit report to say, hey, what are the inquiries you've had over the last 4 months? And inquiries are cumulative. So inquiries are going to hurt you if you're doing a whole bunch of them in a short period of time, because it's an indicator of how much credit you're thinking of extending in the future. If you pull your credit once every 6 months, that's normal. This is probably the best analogy is credit is about being normal. I don't know about you, I am far from normal, but nobody's normal. But there's statistically a normal. It is statistically appropriate that hey, you are married, you have a house with a white picket fence, you have 3 children and 2 animals, and that's the statistics. And if you vary from that, then you're off of the norm. And it's okay to have your credit pulled periodically. But if you're having your credit pulled 6 times in 3 weeks, there's something weird. It's an anomaly, and it says this person's trying to charge up a bunch of debts. Do they know something we don't know? Historically, when people get a lot of inquiries, it means that they've got some big expenses coming up they don't know how to handle, or they're going to open up new debt, and we haven't had a track record of how well they've paid on that new debt. And so that's what inquiries are looking at. There is such a thing as a soft inquiry that is not visible to lenders. It's like you pulling your own credit score and seeing what it looks like, but it isn't really, and I can pull a soft inquiry. I have the ability to do that, but it's not very functional. I only get one credit score. I can't run it through my system in the same way. But if somebody says, hey, John, I'm not sure if my credit's even good enough to move forward, maybe a soft credit pull is the right way for us to go to get a starting point instead of doing a hard inquiry. But if you know you want to move forward or you want real numbers, a hard inquiry is our only option. Okay, so I'm going to cover a couple of things here in general. The first thing I want to talk about is credit card offers. So do you get a lot of credit card offers in the mail? Because if you do, there's a way to minimize that. And it actually can give you a little bit of a boost to your credit score. It's not supposed to. So this is kind of a myth that actually works, even though we're told it doesn't. Data is sold by the credit agencies to these credit card companies, and they do a soft inquiry. But you can opt out of that. You can go to optoutprescreen.com. That's optoutprescreen.com. And you can opt out of receiving pre-approved credit offers. It will help you to be able to, first of all, not get all these solicitations, but secondly, anecdotally, it actually I've seen it improve people's credit scores a little bit, because the chance of you opening up new debt decreases pretty significantly when you're not getting a whole bunch of offers in the mail. Okay, so rapid fire, lots of different things I want to cover for the next 20 minutes. There's only 2 ways to fix bad credit. The first way is you got to build better credit. Time heals all wounds. So if you have late payments in the past, if you have negative credit history in the past, your first option, just start paying on time. Keep balances on your credit cards, pay them on time, build new credit that's better. The second way to fix bad credit is to repair your credit from the past. Now, you can pay somebody else to do it or you can do it yourself. But really, the key is when you're building new credit, you have to do three things. You have to pay all your bills on time. It seems pretty self explanatory, but it's super important. If you are trying to repair bad credit from the past, pay all your bills on time. No need to pay extra, but pay the minimum on time. The second thing I suggest is you open 2 to 3 brand new accounts. You say, John, wait a second. I thought you said it was a bad thing to open new accounts. It is, but it's a really bad thing if 100% of the accounts that you have a negative credit history. So statistically, if you replace those accounts that had a negative history with new accounts that don't have a negative history, now statistically only 30% of your accounts have a negative credit history. The other accounts have good credit. So that is super important. Remember, keeping the balance between 10 and 30% of the credit limit. Collections are very, very misunderstood. If you have collections, first of all, always pay your bills, always go back and pay collections if they're old. I'm speaking specifically to how to build credits. If you have a collection account that is over 2 years old, do not pay it off because doing so will likely harm your credit score. An unpaid collection from more than 2 years ago is less harmful. It will look worse because it's showing now as a paid collection that just happened, which makes it look like you were just unable to pay it, and it actually is more of a drag on your credit. If it's more recently than 2 years old, then paying it down will help your score. Over 2 years old and paying it down will likely drag your score down. Utilization. Is there a quick fix to that? Remember, utilization is how much do I owe compared to my credit limit. The thing is that you can actually increase your credit limit. Most people think the only way to improve utilization is to pay down your credit cards. But if you have decent credit and a good relationship with the creditor, pick up the phone and call them. Hey, are you willing to increase my credit limit? If they do increase your credit limit, then you're immediately going to get a boost to your credit score because instead of owing $1,000 on a balance on an account that has a $1,500 credit limit, that means you owe 66% utilization. You actually increase your balance to 3 grand. Now you owe the same $1,000 on a $3,000 limit. It means you have a 33% utilization. So utilization is the quick fix to either decrease your balance or increase your credit limit. The second quick fix is if you have any currently delinquent accounts. That is the biggest negative. The absolute biggest negative is that you have currently delinquent accounts. Then you pay that to catch it up and it becomes current. Those two issues, I've seen as much as an 80 to 120 point improvement immediately. So that is a very easy way to improve your credit if those two things impact you. Okay, so there's something called Credit Boost. If you've heard of Credit Boost adds your utility bills, your phone bills, your rent, all of that stuff to your credit score. I've got mixed feedback from clients about this, but here's what I'll tell you. It does not help with your mortgage credit score. So if you're trying to improve your score for the purpose of buying a home, Credit Boost does nothing for you. It's not worth the effort to do it. Okay, so now let's talk about consumer disputes. So first of all, in 2010, lenders required that all disputed items on your credit report have been removed prior to loan approval. So let me explain what a dispute is. A dispute is when you have said to the credit agencies, that bill is wrong. They said I paid late last year and I didn't pay late. I've never been late. The credit system wrote the rules to say, well, gosh, if you've said that that's wrong, then I'm not going to require that that impacts your credit score because we got to get that fixed, and I'm not going to penalize your credit score for something that you've clearly said is wrong. They're giving you, the consumer, the benefit of the doubt. But the problem is people took advantage of it. And a lot of credit repair companies, they simply dispute everything. And that hides everything behind the veil of the dispute. and it immediately raises your credit score. The mortgage industry caught on. So we will require, in most circumstances, that you undispute those items, that you remove the veil that is covering them, and often it causes your credit score to decrease. So be super careful with credit repair companies telling you to dispute everything, because the improvement in credit score is temporary and the mortgage industry will not let you use it. Here's how you remove dispute verbiage. You've got to talk to the creditor and request, hey, I'm no longer disputing this. And you need to get written confirmation saying the dispute has been removed. That process can take 30 to 45 days to report naturally. Now, I say report naturally because we can do something called a rescore. And I'll talk about that here. So you can also call the 3 credit bureaus. These 3 phone numbers are super, super important to have. So if you don't have them, you can Google it, but these are the phone numbers to call the direct credit bureaus and remove the disputes with them, and then I can request a rescore for in a time crunch. Now that costs a pretty sizable amount of money for me to pay for a rescore, and it doesn't guarantee that we're going to get the results back that quickly. But if we're in a time crunch, I can do that, and I would be happy to do that for you. If we're not in a time crunch, we're going to let it take the natural time of 30 to 45 days. We want to pay attention to this early in the process. So let's talk about rescores and what does it mean. First of all, it's a very, very misunderstood concept. It does not change a bad scoring history. Okay. What it does is it gives me a temporary adjustment. So I'm basically saying, hey, I've got a letter right here that says that you've paid down this bill or you fixed this thing on your credit report. And I can take that letter and I can send it in and I can get a updated report showing that item changed, but it's not permanent. It still has to process through the system. So it is something that is very misunderstood, but we can rescore your credit when necessary. It just needs to be used appropriately, and it's very, very misunderstood. Here's some reasons why I would rescore. If it's wrong payment history or wrong balances, if an account that shows as a charge off was actually discharged through a bankruptcy, um, accounts that show a lot of available credit that is incorrect, or a missing accounts that have on-time payment history, we can often get rescores for that. Okay. So now I want to play a little game called fact or fiction. So the first thing is, paying cash helps repair bad credit. The answer is no. You need to prove responsibility to rebuild your credit. So do not think that, oh, if I pay for cash for everything, it means that I'm not using credit and that means that my credit's going to get better. It's not. Here's the second thing, fact or fiction. Every inquiry drops your credit score. It does, but not very much. It's really, really minor impact. So people overthink how much an inquiry is going to impact their credit score. It's really small. You don't want to do a lot of them, but it's okay to do inquiries periodically. All right, so fact or fiction, having too many credit accounts hurts your credit rating. It's actually the opposite, okay? Too few credit accounts can hurt you because your it has to do with credit history and how many accounts you've had and what is normal, and B, it has to do with your ability to prove self-control. So if you get rid of all of your accounts, you're really getting yourself in a position where you're saying, "Hey, I have no ability to charge money, and therefore I'm not demonstrating my self-control. I'm demonstrating avoidance, and that doesn't help rebuild your credit." We talked about authorized user accounts. They absolutely can help your credit in some circumstances, but they can backfire if the authorized user has any negative credit history, or if they pay a bill late, or if they charge up significantly. Then an authorized user account can have a pretty sizable negative impact to your credit. All right, next thing is credit limit increases. Can they help your score? 100% of the time, yes. And most people do the opposite. Most people say, oh, I'm trying to buy a house. I want to lower my credit limits because the bank thinks that will help me. We talked about this in depth earlier. It's just not true. You want to have as high of a limit as you can with as small of a balance on that limit. Should I close a credit account that I don't use? No, because A, it decreases the amount of available credit and increases your utilization, and it has to do with the length of time that you've had credit cards open. But this is a really good point for me to stop and explain. Utilization is per credit card. So if you have 4 credit cards and each of them have $1,000 credit limit, One is maxed out, the other three you owe nothing. That's very bad because it says that you have 100% utilization on that one card, even though in your mind it's like, well, John, I have $4,000 of available credit because I have $1,000 on each of these four cards, and I owe $1,000 in total. So therefore, I have 25% utilization. We don't think in total. The system does not score in total. The system scores per account. So you need each account to be below 25% ideally. Now, if you're at 80% utilization on every one of your credit cards, the first thing you should do is ask for a credit limit increase. The next thing you do is you get every one of the cards below 50%. Now, if you don't have enough money to get every one of them down, get the small balance, small credit limit ones down, because then you only have one that's at 80% utilization and four that are under. That's better than having all four of your credit cards that are at 80%. So I know that that's a little bit of an obscure example, but it's really, really important. It's all about statistics. What percentage of your cards have a negative attribute? And so if you cannot achieve perfection, then we want to at least get the majority of your accounts in that green zone, in that better area. This is really where I said earlier that this is like medical advice. It is. And I told you, you got to be careful about what advice you listen to. Hear me loud and clear. I don't want you following any of the advice that I just spent the last 50 minutes talking to you about. That might sound pretty silly because I just wasted an hour of your time and now I'm telling you, don't follow any of my advice. What I'm telling you is take what I am telling you and digest it and then talk to a professional. Call my office and talk to somebody on my team. Let us pull your credit and let us give you advice on how you improve your credit in order to qualify for a mortgage, in order to qualify for that refinance that you're trying to do. Do not try and go it on your own, because anything that I said that you should do today, taken out of context, can have the opposite impact and can actually lower your credit score. So let's talk about once you've paid a past due debt, fact or fiction, it'll automatically drop off your credit report. That is not true. Paying off a past due debt only shows it as a paid negative item on your credit report. The key, if you want a quick fix, is do what's called a pay for delete. Let me explain to you what pay for delete is, because this is super important if you have current active late or collection accounts. You cannot do a pay for delete on regular credit cards. Okay. Nobody's going to delete a credit card that you've had. Nobody's going to delete a student loan or a car loan that you had. But if that account becomes a collection, you can do a pay for delete on that collection account. You call the collection agency and you say, hey, I want you to remove this from my credit report. And if I pay you, I will only pay you under the circumstances that you remove it from my credit report. They will say no. They will say it's impossible for us to do that. It's against the rules. They'll say, I'm going to show it as paid. Don't worry. It's gonna get rid of the negative mark as being unpaid, but it's still going to be a negative mark of the fact that you couldn't pay it. But here's the trick. The trick is you have to call enough times and talk to enough people so that sooner or later they give up. They say, you know what? I'd rather have your money than to have my name on your credit report. Yes, I will delete this from your credit report if you pay this bill off. Again, it only works for collections, but you're paying that collection only when they put in writing that when you pay them, they will delete it from your credit report. Now, a lot of people say, John, I want to do a pay for delete, but I want to settle. Sure, if you're a great negotiator, that's fantastic. But remember, you're negotiating. And so if you're asking for something big like a pay for delete, you're not as likely to get the settlement to be as low as you'd like it to be. But getting it off of your credit report can have a significant improvement to your credit score because it will be as if the collection was never there. So pay for delete is a phenomenal tactic if you have collections that are unpaid. Once you've paid them, there is no incentive for the creditor to delete it. There's no requirement for them to delete it. You'll never get it off your credit report. It'll take 7 to 10 years to fall off. So if you have active collections right now that you need to get off of your credit report, you can do a pay for delete by paying them only when they give you a letter that says, I will delete this when paid. All right, so let's keep going through fact or fiction. I'm done with fact or fiction. I want to talk about 4 common credit mistakes that people make. The first one we've talked about a lot is asking your creditor to lower your credit limits. I think I've beat that horse to death. Making a late payment is huge, guys. This 35% of your credit limit is payment, credit score is payment history. Pay your bills on time. Consolidating your accounts. That might, remember, things that are bad for credit may be good for life. So consolidating your credit might be a good life step. It might be a good financial move because you get a lower payment, you get a lower interest rates, but consolidating the accounts can hurt your credit score because most of the time you're paying off those old accounts and closing them. And now you've lost the credit history with those accounts and you've lost the available credit from those accounts. Same thing with closing old accounts we talked about. And don't apply for new credit if you already have plenty. If you have great credit, again, I like to think of credit scores like a heart rate. So if you are healthy, you're going to have a certain heart rate. And if you're healthy and you are exercising, your heart rate's going to go up. And your heart rate's going to come back down when you're done exercising. That doesn't mean that you have a problem with your heart because you have a high heart rate. Same example, maybe a better example is blood pressure. So there's a healthy level of blood pressure. But if you're under stress, your blood pressure is going to go up. Does that mean you have a problem with high blood pressure? No, it just means that your blood pressure changes, your heart rate changes when you're sitting versus when you're standing. All of these things play into account with your credit score. If you have great credit's anything over 760. From a mortgage perspective, you will get anything you want if you have a credit score of over 760. Do not try and maximize your credit to say, how do I get over 800? Who cares? You have amazing credit. Live your life. It's just like saying, how do I get exactly 120 over 80 on my blood pressure? I'm 121 over 82. Well, you're probably causing problems with your blood pressure by stressing over trying to make your blood pressure perfect. The same thing with credit. If you have great credit and you want to take advantage of a deal that says, hey, I'll get 10% off this by opening up a new account, whatever, open the account. But if you have marginal credit, don't do it. It's going to hurt you way more than it's going to save you. So don't apply for new credit unless necessary. All right, so tips for raising your credit score. We've got a couple of minutes left here. I am pretty close to done. Yeah, I'm done, almost. All right, so let's go back. So pay your bills on time. That's like tips for raising and improving your credit score. Pay your bills on time, which is within 30 days of the due date. If you were behind, get caught up and stay current on all of your payments and make sure you've got a strategy to stay on time. That means don't pay more than the minimum, just pay the minimum. Let me say it that way. Only pay the minimum and keep extra money in the bank so that if you have a tough month and you're like, man, I can't afford to pay my credit cards. Oh, wait, I can because I have extra money in the bank that I put over there. Instead of paying extra on top of my minimum, I have a reserve account. That rainy day fund is super important to your ability to maintain good credits, is to make sure you have money there because the unexpected happens all the time. Remember, keep balances low on credit cards. Below 30% of the credit limit is ideal. Don't close credit cards once they're no longer needed. Don't open up a lot of new credit cards, and check and monitor your credit history often. Okay, you would go to freeannualcreditreport.com. I thought I had a slide in here for that. Freeannualcreditreport.com. That is the only place to get a free credit report. As a matter of fact, Anna will put that on a ticker on the bottom. www.freeannualcreditreport.com. That is the only place that you can truly get a free credit report. You get one per year from each of the agencies. The best thing to do is to pull your credit through there once every 4 months, so that you pull one in April, you pull one in September, and then or whatever, April, and then August, and then December. And so you're pulling freeannualcreditreport.com. Thank you, Anna. So that is the place to get it. You don't get a credit score, you get the credit data. But what you're doing is making sure that there's been no identity theft. You're making sure that those accounts are correct and that there's no negative history that is incorrect. So let's talk about foreclosures and short sales. I don't expect we're going to go into a market where we're going to see a whole bunch of foreclosures and short sales, but if you had one in the past, the truth is they're both going to have an impact on your credit score, but a foreclosure usually has more of an impact because it's had a lot longer negative payment history. But really, that's a case-by-case basis, so I'd want to talk to you about that in particular. If you've had a bankruptcy in the past, you can apply for a loan in as little as 4 years from the discharge date on a Chapter 7 or 2 years from a Chapter 13 on a conventional loan. FHA, you've got to wait 2 years on a Chapter 7. You can actually do a Chapter 13 immediately after discharge. So as a matter of fact, you can still be in the middle of the payment plan as long as you've been paying on it for at least a year. So call me if you've had a bankruptcy and you're curious about your ability to qualify for a mortgage. You'll be surprised. USDA and VA loans have similar guidelines. The truth is, FHA is the most forgiving, which is going to be 2 years from the Chapter 7 discharge or 1 year after you started making payments on a Chapter 13. And then how long do you have to wait to buy a home if you've had a foreclosure or a short sale? Foreclosures, you could buy a home as little as 2 years if you're VA, or 3 years on FHA. And the same thing with short sales, 2 years if you're VA. So if you're veteran of the US military, you have more flexibility. If you're FHA, then you have to wait just 3 years. Guys, that's it. I am right at the top of the hour. Thank you, thank you, thank you for joining me. Next Friday, 12 noon, I'm going to have another pre-recorded broadcast. I'm going to be bringing in an insurance specialist to talk about everything you need to know about insurance, homeowners insurance, car insurance, renters insurance, life insurance, things that are really confusing for a lot of people that they need to understand how all of this works together. So join me next Friday, and we're going to be talking about the homeowners or the insurance and demystifying insurance. Register by going to rsvpwithjohn.com. And if you want to go to my YouTube channel, I'd love for you to subscribe there. Click the notification bell so that you can get all the notifications anytime I release new videos. And I thank you for your trust. I thank you for the opportunity to help guide you. Reach out to me or my team if you have any questions.